With reciprocal tariffs officially in place and the stock market taking a dive, many of you watching this may be wondering what the short and long-term implications are for your retirement plan. So by the end of this video, my goal is to give you some clarity as to what you should or should not do in response to the recent tariff rollout to make sure your retirement stays on track. If this is your first time here, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. My partner Chris and I help people across the country retire with confidence and clarity. So first and foremost, what is a tariff anyway? A tariff is a tax paid on imported goods by the country that's importing those goods. So for example, if the US imports car parts from China, which now has a 34% tariff, US-based companies will pay 34% more than they were before tariffs. Tariffs increase government tax revenue, but the bigger goal of Trump's tariff policy is to incentivize US-based companies to spend their dollars domestically rather than abroad, thereby theoretically boosting economic growth. But because US companies are not expected to just eat this cost, they're likely to pass it along to the end consumer in the form of increased prices, leading to inflation. So what does this mean for your retirement plan? There's a few short-term implications that come to mind. For those entering or already in retirement, inflation means your day-to-day living expenses could rise, so it's important that your retirement plan projections account for this. If you use a bucket approach in your investment portfolio where you allocate a certain number of years to safer assets like cash and bonds, it might be a good time to reassess whether or not you have enough allocated to those buckets to sufficiently meet your cash needs for those next few years. You may also consider tips for these buckets, which are Treasury inflation-protected securities that adjust upward for inflation each year based on the consumer price index. Tariffs can also bring short-term stock market volatility. At the time I'm recording this, the S&P 500 is down about 4%. And while it might be tempting to sell your investments to prevent further losses, emotional decisions like this often do more harm than good. When you try to time the market, you have to be right twice. You have to know when to get out, and you have to know when to get back in. Knowing just one of those has historically been nearly impossible to predict, much less knowing both of them. Besides, some of the best stock market returns have come right after sharp declines. Referring to market downturns, a wise man once said, "You've already experienced the risk, you might as well stick around for the reward." Some of the longer-term implications that tariffs can have on your retirement plan can be summed up with the following statement: we just don't know. With that said, persistent tariffs and trade disputes can shift the balance of global economic growth. That might mean slower growth for some international economies and new opportunities in others. For long-term investors, this highlights the importance of global diversification. For decades, the US stock market has outperformed international stock markets, but tariffs could change that. In fact, we've seen a glimpse of that so far this year, with international markets outperforming US markets by double digits in just the first 3 months. Now, will this continue into the future? Once again, we just don't know. But having a portion of your portfolio invested in international companies at all times can smooth out your returns in times like this and position yourself for growth wherever it may occur. In the long run, there's also a real possibility that tariffs could lead to reduced business investment, higher consumer prices, and lower consumer spending, all of which could slow the economy and trigger a recession. For those that are not yet retired and working jobs in cyclical industries, this might be a good time to build up your emergency fund a little bit more in the event of a job loss. For retirees that are worried about the long-term effects of market volatility, a brief look at history will tell us that there's always going to be a headline or a reason investors might want to get out, but the market has always gone on to reach new highs. In other words, your retirement plans should already account for moments like this, so take a deep breath and zoom out. And finally, if you're considering working with a professional to navigate your retirement plan, I'm currently offering a free retirement assessment to show you what it would look like to work together. You can schedule that at the link below this video. Besides that, thank you for joining, and we will see you in the next one.